The gold price is rising despite the fact that interest rates are going up, despite the fact we've had de-escalation to some extent in the Middle East. People are saying none of that matters, because what really matters is, what am I going to get back if I go for the other thing that I could buy, which is treasury bonds? What will they give me in 10 years or 20 years?
You're watching Silver News Daily. Subscribe for more.
Could silver really skyrocket to $100? Some experts are calling this the most critical moment in economic history, where record-breaking debt and hyperinflation could trigger a global fiat meltdown. With central banks and investors scrambling into precious metals, is silver your last chance to protect your wealth? Stick around, because what I'm about to reveal might completely change how you see the future of money.
In history, it's not just the USA, it's around the world. Governments have got into the habit of overspending, starting with the global financial crisis when they bailed out all the banks. And then we went through the COVID crisis when they printed money willy-nilly to help all those people who were furloughed or lost their jobs and that sort of thing. And having got into the habit of spending money, not only on those types of things, but other things as well, for a while, there appeared to be no negative impact. So these habits of spending more than they're collecting in taxes continued and have got worse. Now, I'm talking about democratic countries here, where it's very difficult for a politician to put his hand up in the air and say, all those benefits we were giving out last year, we've got to stop it now. So cutting the spending is very difficult. There'll be rioting on the streets if you try to do that. Raising the taxes, they're trying to do that, but you can only go so far. If you raise taxes, it stifles economic growth. In the end, the result of that will be lower taxes anyway. So there's not really a very easy answer, but the debt is rising quite fast. We've got interest payments on that debt rising much faster. And the reason for that is that a lot of that debt, which was taken out over the last 10, 15 years by governments, was taken out at a time of zero interest rate policy, ZIRP, Z-I-R-P. So that meant that the interest they were paying on the debt was very low. That debt is reaching maturity little by little over the next decade. So as it matures, they have to borrow the same amount again, plus all the interest, but they're borrowing it at a much higher interest rate. So the interest is rising fairly rapidly. And that means, when I say fairly rapidly, I mean it's quite dramatic. And there's a real possibility that within 10, 15 years, the interest payments by governments will be exceeding the totality.
Silver's recent moves have been catching everyone's attention. After climbing to $31 per ounce, experts say we're only scratching the surface of what's possible. What's driving this surge? It's a perfect storm of global uncertainty and strategic market shifts. Just recently, former President Trump called for an immediate cut to interest rates, claiming it's essential to stabilize the economy. This triggered a drop in the dollar's strength, and whenever the dollar weakens, silver shines. But that's not all. Industrial demand is playing a bigger role than ever, with China, one of the largest consumers of metals, showing optimism about trade negotiations and ramping up production. Silver is gaining momentum as both a monetary and industrial powerhouse. And with U.S. Treasury yields sliding alongside the dollar index, investors are piling into silver as a reliable safe haven asset. It's no coincidence that silver is now trading near $31 per ounce. This isn't just a rebound. It's a signal that the tides are turning. Will this rally last? Or is this just the beginning of something much bigger? Let me know in the comments. Are you stacking silver right now, or are you waiting for the next dip? And if you're new here, make sure to hit that subscribe button. We've got much more to uncover about silver's role in this economic shift.
Well, sentiment has been swinging two ways or three ways, I suppose, in the last few weeks. When they last cut interest rates in December, the view was we'd get two more cuts this year. Then as the bond yield started to rise, sentiment started to change, and actually there was some words coming out of Fed saying we're not in such a great hurry to cut rates. So sentiment started to change a little bit along the lines of it might take longer before they cut them, and we might not even get those two cuts. But recently, just last day or two, we've had some very good inflation numbers in the United States, and the two cuts this year are back on the table. Of course, the Fed can do what it likes at the short end. It can, that's what it controls. It doesn't control the long end unless it steps in with quantitative easing buying government bonds. So really, the short-term interest rate is what's under the control of the Fed. If they want to reduce it now, they can. They've got full justification for doing so on the grounds of those recent inflation numbers. So I think it's likely they will while they can. But whether it be one or two cuts, we'll see. But I think after that, people will be starting to talk about short-term interest rate rises again if there's some sign of inflation resuming. And there are early signs that might be coming back. We're seeing that the oil price in recent weeks is ticking up quite sharply. And of course, any escalation of tensions will cause supply chain bottlenecks for the shipping routes. So we've actually removed the bottlenecks we had a year and a half ago, 2 years ago so we had higher prices a year or two ago because of the war in Ukraine as things started to seize up a little bit. And then there was the COVID before that. So we're coming out of that. So these higher prices are coming off their peaks, which means we've had up until now the benefit of, when we look back a year, looking back over 1 year at peaks. So we're obviously in many products lower than we were a year ago, but having seen that decline, we're no longer at peaks. So when we look forward a year, it's quite possible that the prices will be up and rising again. There's no hill to come down anymore. We've come down the hill. So can it go down the hill further? I think it's much more limited now. So yeah, I think inflation will be coming back, and I think the Fed at that point will have to be thinking about what it does. Will it change its 2% target? I think it will. I think it will probably change the 2% target to 3%. It won't be alone. I think the whole world will do that. Currently, they're sort of sitting at 2%, but looks like it's an unachievable target. So I think we'll probably see some sort of collective decision as they gradually, central bank by central bank, say our new target is 3%.
Silver has always been the underdog of precious metals, but here's a little-known fact. It doesn't just follow gold. It often outpaces it. Historically, during periods of high inflation or economic uncertainty, silver's price movements tend to be even more explosive. Why? It's all about its unique role as both a monetary asset and an industrial commodity. Unlike gold, silver is heavily tied to global industry. This means it benefits from surging demand in key sectors like electronics, renewable energy, and advanced technology. But when the economy falters and inflation soars, silver flips the script and acts like gold, becoming a store of value and a hedge against crumbling fiat currencies. It's this dual nature that gives silver its extraordinary volatility and potential for outsized gains. For example, during inflationary periods, silver has been known to rise twice as fast as gold. And with the global economy teetering on the edge, could this be silver's moment to shine? The question is, will silver's historical patterns repeat, or is something entirely new happening this time? Drop your thoughts in the comments, and don't forget to subscribe so you don't miss the next chapter of this story.
Well, yeah, in simple terms, the short-term rates, the overnight rate or the Fed funds rate, is down by 1% in the last 6 months. And the long-term rate, the 10-year rate, is up by 1%. So we've had the two rates move in completely opposite directions. And the reason why that's happening is I think people are saying there is this huge borrowing requirement which is happening, partly due to the rising interest costs of the debt and partly due to the expanded budget deficit, with no real plans to address it at the moment. They may come, but they're not there yet. And people are saying, if this continues, investors like me are going to get indigestion because I can't afford to buy any more treasury bonds. At least I'm not going to buy them at 4.5% anymore. I need 5% or 5.5%. Now, there will come a point when that interest rate, which the government would have to pay to borrow money will be unpalatable for the government, because it will be accelerating the spiral out of control. Instead of a slow, painful death in the value of government bonds, it could spiral to a very rapid decline. So before we get there, and we won't get there, but before we get there, the Federal Reserve will be asked or invited or instructed or ordered, or will just decide on its own to step in and start to buy the bonds from the primary dealers, which the government is selling the treasury bonds to the primary dealers to raise cash. The primary dealers will be selling them to the Federal Reserve, and the Federal Reserve will be expanding its balance sheet, because where's it going to get the cash to buy those bonds? Well, the way it's always got the cash in the banking crisis and the COVID pandemic, and the way it will do it next time, which is coming soon, they will print money. So what we'll see is an expansion of the money supply as the Fed prints money to buy those bonds, and they'll be buying the bonds to stop the interest rate or stop the yield of those bonds rising beyond a certain point. And of course, we all know what that will mean. It'll mean a lot of cash entering the system, and someone somewhere is getting all that cash. And what are they going to do with it? Well, they're going to buy tangible assets. They're not going to put it back into treasury bonds unless they think the interest rate is high enough. But the interest rate won't be high enough because it's been suppressed by the Federal Reserve.
Here's where things get really interesting. The looming specter of hyperinflation. Global debt is spiraling out of control. Governments are borrowing at record levels to stay afloat, and it's creating an economic pressure cooker. The U.S. alone has seen its interest payments on debt soar as old, low-interest bonds are replaced with new ones at much higher rates. Some experts predict that within the next decade, governments might spend more on interest payments than they collect in taxes. Let that sink in for a moment. What happens when confidence in fiat currencies begins to crumble? Historically, people turn to hard assets, gold and silver. But silver's accessibility gives it an edge for retail investors. It's cheaper, easier to accumulate, and often seen as gold's little brother. As inflation eats away at the value of paper money, silver becomes not just a hedge, but a lifeline. We're already seeing early signs of this shift. Central banks have been stockpiling gold, but silver is where retail investors are focusing their attention. With inflation targets looking less achievable by the day, and whispers of governments raising those targets to 3% or more, silver could become the ultimate weapon against the erosion of wealth. So what's your strategy if hyperinflation becomes reality? Are you prepared, or are you betting on the system holding together? Let's discuss in the comments. And if you haven't already, hit that subscribe button. We're only just beginning to unravel this story.
Their tax take. That's a possibility. Certainly it will be happening if nothing changes by the time my children are coming into retirement. So I don't think there's a lot of hope for the next generation in terms of being able to repay that debt. I think the governments are going deeper and deeper into debt. They don't have a way out. They don't know how to get out, and I don't know the answer. So, where's it all going to go? And I think people are saying, I'm not going to get paid back in something which will buy me something. I might get paid back my money, but what will I be able to do with the money then when there's so much of it? So I think people are saying gold is my plan B, it's my parachute, and they're buying some gold to store value. And of course, we've got the central banks now seeing the same thing. We've had quite a bit of buying last year from countries like Poland, and obviously China was one of them. And I think although China wasn't the biggest buyer of gold last year, I think Poland was, people are taking their lead from China, who in the month of December bought twice as much gold as they bought in November. In November, they had, that was after a several month break when they hadn't bought any gold. But the increase in China's reserves over the last 12 months, 80% of that increase has come from gold itself, a mixture of buying gold and the rise in the gold price. Now, what that's saying, China is buying gold, and gold's at an all-time record. They are valuing gold more than any other asset they could buy. So I think other central banks are taking notice, and it'll take a long time for central banks to react to this, because if you're going to increase your gold holdings in any central bank, you've got to have your legal department on side, you've got to have the compliance department on side, the risk department on side, the management on side, the investment department. There's going to be all these different departments, the economics department, who've got to be consulted, brought on side before they start to buy gold. But little by little, I think other central banks will be following suit in the wake of what China's doing. And I think those who can see that that is coming are saying, well, I don't want to be the last one to the post. So they're starting to buy today. And that's why the gold price is rising, despite the fact that interest rates are going up, despite the fact we've had de-escalation to some extent in the Middle East. People are saying none of that matters, because what really matters is, what am I going to get back if I go for the other thing that I could buy, which is treasury bonds? What will they give me in 10 years?
Now, let's talk about one of silver's most exciting drivers, industrial demand. While silver has always been prized as a monetary metal, its role in cutting-edge technologies is reshaping the market. The transition to green energy alone has created an insatiable appetite for silver. Solar panels, for instance, rely on silver as a key component, and demand from this sector hit a record high in 2024, over 700 million ounces consumed in just 1 year. That's staggering. And it's not just solar. Electric vehicles, 5G infrastructure, and artificial intelligence are all heavily reliant on silver for their manufacturing processes. The latest photovoltaic solar cells now use even more silver than previous generations, making it indispensable to the future of renewable energy. On top of that, the automotive industry is scaling up its use of silver in electric vehicles and charging stations. This isn't just a temporary demand spike, it's a structural shift that's expected to grow year after year. What makes this even more dramatic is the supply side. Mine output has been declining for years, and while demand surges ahead, the market has been in a supply deficit for 3 consecutive years. Experts project this deficit to continue well into the next decade, with inventories shrinking further. So here's the big question. Can industrial demand alone push silver into triple digits? If these trends hold, the fundamentals are undeniable. What do you think? Are we heading into a silver scarcity crisis? Let me know in the comments, and if you're finding value in this deep dive, don't forget to subscribe for more insights.
Yeah, I mean, if you take an example of a multimillionaire, how many Leonardo da Vinci's or Van Goghs can he buy this year compared with 20 years ago, allowing for the, let's call it 5% a year interest he's earned over the last 20 years? Well, the answer is, even though he's earned interest, even though he may have paid no tax, he can buy far less Leonardo da Vinci's. And the same thing would apply to healthcare. The same thing would apply to anything which is in limited supply. There just isn't enough of it around. Of course, we've seen what the gold price has been doing over the last decade. Well, let's say last few years. It had a dead decade. It's kind of 2000 to 2011 or thereabouts. It massively outperformed equities. Then it had a fairly dud decade, and now it's started again. We're now in a new phase of upwards movement. And the reason is simple. Everybody who can read can see that the government debt is not, the problem of the government debts are not being addressed at all.
Central banks are making bold moves, and while gold has historically been their preferred asset, the ripple effects on silver are impossible to ignore. China and Poland are at the forefront, aggressively increasing their gold reserves, with China doubling its monthly gold purchases in December. The result? A signal to global markets that precious metals are a safe haven as fiat currencies weaken. While silver doesn't benefit directly from central bank buying like gold does, it often follows gold's momentum, especially as retail investors react. UBS highlights that declining U.S. yields and monetary easing could make silver increasingly attractive in 2025. These trends align with improved industrial activity, creating a dual narrative of silver as both a monetary hedge and an industrial necessity. Moreover, the ongoing debt crisis is forcing nations to reconsider the reliability of fiat currencies. With central banks signaling a move toward tangible assets, silver's affordability compared to gold makes it the ideal choice for retail investors aiming to protect their wealth. Are we witnessing the beginning of a global shift in silver demand? Share your thoughts below, and don't forget to subscribe as we continue uncovering these seismic market trends.
First of all, I know that your channel's you quite like gold and silver, but I'm a diversified person. I think the way to play the game is to be diversified in all kinds of assets, and that can include parachute-type assets. Gold and silver could be your parachute for a complete monetary collapse. But you also need productive assets, and productive assets include things like equities. Obviously, you need the right ones, and you need some skill to choose those. And if you can't choose them, at least choose a broadly based exchange-traded fund. That's a fund which owns all the stocks in a particular index. I'll just say that I do not like at all the S&P 500 ETFs because they're very heavily weighted. Well, they're totally weighted to the USA, and secondly, they're very heavily weighted to the 7 largest companies, something like 35%, more than 35% now. So what those 7 companies do will be what the ETF does. So if you're going to buy an American-based ETF, probably go for one of what they call equally weighted ETFs, which has 500 shares. Each one has an equal weight. That's a safer approach to have an equally weighted index, but you'll miss out, of course, on those 7 largest companies, which have been the ones going up like rockets and driving the market, but there's no guarantee that will continue. So productive assets also include real estate. Now, there's 2 ways to own real estate. You can buy apartments or houses and let them out, or you can go for a real estate investment trust. That's a fund which owns lots of properties. They do all the management for you. You don't have to do anything. All you do is collect the dividends and you can sell the fund any day. It's highly liquid. Virtually no bid and ask spread, unlike a property where you might spend months trying to sell it. So it's a choice on which one you want to do. You'll probably make more money if you own the property directly, but you'll probably have a lot more hassle dealing with tenants, taxes, repairs, government taxes, and all kinds of things like that. So that's a personal choice to what people prefer. But tangible assets is what you want. What you do not want, if you're saving for retirement, is cash in the bank, money market funds, bonds of every description. That includes government bonds and corporate bonds, or anything which is going to repay you only in fiat, unless, of course, the interest rate is sufficiently higher than the depreciation of money. And given the rate that government debt is increasing, you probably want a much higher rate than 7% today to even justify thinking of it, and even more if you're going to pay tax on it. So really, I wouldn't be looking at bonds or cash or money market funds myself for long-term savings. If you need money for the short term, and you might, like for emergencies or day-to-day living, keep that in short-term treasury bills or cash. But you really don't want to have your long-term savings tied up in an asset which is going backwards.
Retail investors are stepping into the silver market like never before, and the data speaks volumes. In 2024, we saw a surge in physical silver purchases, with coins and bars flying off the shelves. Exchange-traded products, EPs, tied to silver have also seen inflows for the first time in 3 years. This marks a major turnaround as investors pivot from speculative gold buying to more diversified strategies that include silver. What's driving this shift? For one, silver is significantly undervalued compared to gold. The gold-to-silver ratio, currently hovering around 90:1, is well above historical averages, signaling that silver is on sale. Historically, when this ratio becomes distorted, silver tends to snap back with explosive price gains. On top of that, silver's volatility works in its favor during bullish cycles. Smaller market size means even a modest uptick in demand can cause sharp price movements, making silver a favorite for investors looking for big returns. With inflation fears, global debt issues, and industrial demand all converging, it's no wonder retail interest is surging. But here's the real question. Are retail investors driving this surge alone, or is this the beginning of a broader silver renaissance? Let me know what you think in the comments, and don't forget to hit subscribe. There's more to this story than meets the eye.
Consumer price index, but they'll be rising by the increase in wealth which is being created by the government borrowing money, thus the government gets poorer, and spending that money, and someone gets that money. Who gets that money is those who are saving for that, successfully saving for their retirement. Let's face it, not everybody can do that, but those who do it successfully spend less than they earn, and they build up a nest egg for their retirement to live off, so that when they get to retirement, they can buy themselves a nice home. Maybe they can do a home extension. Maybe they can have a nice holiday. Maybe they can pay for their grandchildren's education. But all of these things that they're going to spend the money on in retirement, perhaps nice paintings on their walls, it could be anything, they're the things which are in limited supply. And because there'll be far more people like them with far more money, because the government's printed it, or rather the government's spent it and borrowed it, those things are going to be rising at a much faster rate than the consumer price index. So the government's getting poorer to the tune of 7% a year, let's say, in America. That's a very rough and ready figure. We're at, a debt of 35 trillion now, I think, and people say it's going up by a couple of trillion a year. What's that? That's about 7%. I think it's nearer 3 trillion a year going up. But the debt is rising by 6-7% a year. That's way more than the consumer price index. And all of that extra wealth which is being created as the government spends the money goes into the hands of someone, somewhere. And at the end of the chain, there are people who are saving that for spending on the luxuries of life, the rarer goods. So, yeah, it depends who you are and where you are in life and what you're going to spend your money on. But you're going to need money which will you're going to need things which are costing a lot more in retirement than the general increase in consumer prices.
Retail investors are stepping into the silver market like never before, and the data speaks volumes. In 2024, we saw a surge in physical silver purchases, with coins and bars flying off the shelves. Exchange-traded products, EPs, tied to silver have also seen inflows for the first time in 3 years. This marks a major turnaround as investors pivot from speculative gold buying to more diversified strategies that include silver. What's driving this shift? For one, silver is significantly undervalued compared to gold. The gold-to-silver ratio, currently hovering around 90:1, is well above historical averages, signaling that silver is on sale. Historically, when this ratio becomes distorted, silver tends to snap back with explosive price gains. On top of that, silver's volatility works in its favor during bullish cycles. Smaller market size means even a modest uptick in demand can cause sharp price movements, making silver a favorite for investors looking for big returns. With inflation fears, global debt issues, and industrial demand all converging, it's no wonder retail interest is surging. But here's the real question. Are retail investors driving this surge alone, or is this the beginning of a broader silver renaissance? Let me know what you think in the comments, and don't forget to hit subscribe. There's more to this story than meets the eye.
A lot depends on how you spend your money, because everybody's inflation rate is different. But I think the main thing to say is the consumer price index isn't very representative if you are saving for your retirement or you're saving for some luxury later on in your life. The consumer price index is reflecting the prices of goods which are consumed by the masses. And these goods are all produced by robots. As an example, the television one of my screens, that one there is a 65-inch TV. I bought it about, 5-10 years ago now, maybe 15 years ago, I can't remember now. I remember the price. It was 6,000 and something Swiss francs. It's a UHD TV by Samsung. Today, I was in an electronics shop and I saw exactly the same make of TV. It's probably got more bells and whistles than this one. It's got the same number of pixels. It's still UHD. 540 Swiss francs, 65-inch. So 1/10 of the price. So mass-produced items have been coming down in price. But what's not going to come down in price, and what hasn't come down in price, are the things that you're saving up for to enjoy life in your retirement or when you get older. These are the things which are not mass-produced. They're things like holidays and travel. These are things like healthcare, things like nurses and old people's homes. You want to have to go to a home at some point and be cared for by a nurse who'll look after you, change your nappies or whatever you need. That's not going to get any cheaper. And the price of those types of things will be rising not by the
Clive Thompson has been ringing the alarm bells, and his warning couldn't be more relevant. Fiat currencies are on the brink of collapse. According to Thompson, global governments are trapped in a vicious cycle of debt that they simply can't escape. Interest payments are skyrocketing. As old, low-interest bonds mature, they're being replaced with new ones carrying much higher rates. The result? A debt spiral that threatens to destabilize entire economies. Thompson predicts that central banks will be forced to resort to drastic measures like quantitative easing, essentially printing money to buy government bonds. This move might temporarily keep borrowing costs in check, but the long-term effects could be catastrophic. Runaway inflation and a collapse in confidence in fiat currencies. This is where precious metals, particularly silver, come into play. As the value of paper money erodes, silver becomes a haven for investors seeking to preserve their wealth. Silver, with its affordability and dual role as an industrial and monetary asset, stands out. Retail investors are already taking note, buying up physical silver in record amounts. But could Thompson's dire prediction be the catalyst that drives silver into triple digits? Is this the moment where silver steps out of gold's shadow and becomes the ultimate hedge against financial chaos? What's your take on Thompson's warning? Is silver the safety net we need in these uncertain times? Let me know in the comments, and don't forget to subscribe so you don't miss the rest of this critical discussion.
That you're not going to be paid in the same currency as you bought into. You might get paid in Italian lira or French francs. If you're going to get paid in Deutschmarks, you're happy because Germany has got fairly sound finances, but some of the other countries do not. So that's the danger. And don't forget, we nearly saw the entirety of Europe fall apart shortly after the global financial crisis. I mean, if you remember, then we had what's called the PIGS, the Portugal, Italy, Greece, and Spain. There was also Ireland in there, which were the interest rates on their bonds were rising at one point very, very rapidly, and they were going to go bankrupt. And in fact, one country did in fact go bankrupt. I mean, they defaulted. They'll deny that, but the fact is, the private investors lost most of the money. The only people who got repaid in full was the European Central Bank and the IMF. Everybody else had to go whistle. That was Greece, which was basically forced to default on private investors. So Greece is now apparently a sound country. It's safer than France, according to the bond yields. I don't believe it myself, but there you go. So my point is, it nearly broke apart. And the reason they effectively defaulted on private investors was if they hadn't done so, then the whole Eurozone would have fallen apart then and the Euro would have ceased to exist. So we're back together again, but once again, the strains are showing and we could go into another crisis at some point. So don't panic, but probably you don't want to be holding too much in cash or euros or fiat currency unless you just need something for your short-term needs.
Clive Thompson's recent warning of the global economy paints a grim picture. Governments are drowning in debt. Central banks are signaling distrust in fiat currencies, and hyperinflation is becoming an unavoidable threat. According to Thompson, the Federal Reserve's ability to contain this crisis is slipping away, with monetary policies like quantitative easing likely to return sooner than expected. And when the Fed starts printing money again, the value of fiat currencies could spiral downward. But here's where silver comes into play. Unlike fiat money, silver offers intrinsic value. It's both a hedge against inflation and a critical component for industries driving the future. Solar energy, electric vehicles, and artificial intelligence. As fiat currencies falter, precious metals like silver often take center stage, offering stability in times of economic chaos. Thompson predicts that silver, with its dual industrial and monetary role, could rise faster than gold in this environment. The key takeaway: the current economic conditions are creating a perfect storm for silver to shine. But do you believe Thompson's warning signals a once-in-a-lifetime opportunity, or do you think the system will hold? Let's discuss in the comments, and don't forget to subscribe. There's much more to uncover about silver's critical role in today's economy.
So some countries in Europe, in their own ways, are in political crisis, and we're seeing that reflected in the interest rates. Now, don't forget, the euro is a single currency. But what we're seeing is that the government bonds issued by different countries in the Eurozone, which were, shortly after the euro came into existence, all converged at more or less one rate. Those interest rates are now diverging. So there are quite large differences, more than 1%, between the perceived safest countries, Germany, for example, and more risky countries like France and Italy, for example. So the interest rates on 10-year bonds and 30-year bonds and so on, and 5-year bonds, doesn't really matter what maturity you take, are spreading out. The gap between the different countries is widening. Now, what that means is that there's fiscal strains showing in these countries. Some of the countries have been spending more than they really should be, more than they're supposed to under the EU rules, and this question marks are starting to arise in the minds of investors. Why would I invest in a French government bond, let's say 3.5%, or 4.5%, 3.5%, I don't know what the rate is now, 3.5%, when I could be buying a German one at 2.5%? I'd go for the German one because it's safer. Because even though I might earn an extra 30% over the next 30 years from investing in the French one, I think my chances of getting repaid in the same currency are not as high. So there is I won't say it's a large fear, because I don't want to panic people about the euro, but there is a growing worry that the longer you go out, the more you have a risk.
Now it's time to bring everything together. Silver's journey to $100 may sound far-fetched, but when you connect the dots, it starts to make sense. Record-breaking debt levels and unsustainable government spending are weakening fiat currencies at a pace we've never seen before. Central banks are already preparing for this by stockpiling precious metals, while retail investors are snapping up physical silver as a hedge against inflation. Industrial demand adds another layer to this story. Green energy, AI, and advanced technologies are consuming silver faster than mines can produce it. With 3 years of supply deficits already in the books and no signs of relief, the fundamentals are firmly in place for silver to skyrocket. As investors realize the value of this hybrid metal, both as a safe haven and an industrial necessity, the race to accumulate silver is only accelerating. So is $100 silver possible? When you combine hyperinflation fears, tightening supply, and explosive demand, it's not just possible, it's logical. But remember, this is not financial advice. Always do your own research before making investment decisions. And if you found this breakdown valuable, make sure to subscribe for more insights into silver, gold, and everything shaping the future of wealth.